Hey everybody, I'm Mike DeSepoli. Welcome to the Heritage Market Pulse for Friday, December 10th, 2021. We hope you're having a great week. We've got a lot we want to share with you today. We're talking about developments in the market. It's been a very fluid market. We're seeing a lot of volatility, a lot of news for this market to digest, and we want to go through this with you piece by piece, as well as share some evidence with you that we believe is good news for the market, and we think that this recent correction will resolve itself higher. So let's start with the big news of today. Market participants waiting on the edge of their seats for the monthly CPI Consumer Price Index report. You see the headline here, inflation surging. Gotta love how the media writes this stuff. Surging 6.8% in November. Now, first, before I get further, inflation did not rise 6.8% in the month of November. It is an annualized number. I think the headline is a little bit misleading, but nonetheless, we are seeing inflation rising. However, within this report, there was a couple good pieces of data that we think will suggest that over time, inflation will start to inflect back down. This month's report, which was relative for the month of November, showed a slight decrease compared to the month of October. So the biggest fear for the markets is not just inflation, it's that inflation will become a runaway train that goes higher and higher and higher and shows no signs of letting up. So seeing a slight decrease from October into November is a good sign. And I think there's a lot of evidence in this market that the market itself, right, and the market always knows, the market itself does not believe that inflation is going to continue to run higher. Now, how do you know that, Mike? Well, let me talk to you about that now. The Treasury market, which is one of the factors or one of the components of the bond market, we know many investors pay no attention to the bond market. The bond market is thought of as very boring, but we tend to draw a lot of clues from the bond market. So let me give you a little bit of a quick education about the bond market and how this helps us read inflation. I want to point your eyes right here to the US 10-year. We spoke about this in our video the other day, so you might remember this. The US 10-year yield is the number one barometer for the market's expectations, forward-looking, about inflation and interest rates. Now, let me tell you this. If inflation was running hot, and don't get me wrong, inflation is running high. I'm not trying to say that it's transitory, right? Like Jay Powell told us for 7, 8, 9 consecutive months until last week when he said, whoops, it's not transitory. We all knew that. You all knew that. But nonetheless, if the market believed that inflation was a runaway train, this number here today would not be negative on the back of this inflation report. This is telling us that the market does not believe that inflation expectations are going to continue to run persistently high. This suggests inflation will inflect downward. Now, how and why will inflation inflect downward? Well, number one, we know supply chain issues are not going to last forever. They've lasted a lot longer than many of us would like, but they are not going to last forever. Number two, we have many deflationary forces at play in the real economy, right? Technology and innovation is the first thing that comes to mind, helping us do things more efficiently, helping us solve supply chain problems, helping us do things with lower cost and more efficiency for each dollar that we spend. So yes, in the short term, we have inflation. You see inflation. That is a direct result of printing 30% of all the dollars in the world within the last 18 months. But over time, we think it'll deflect downward. And again, when you look at the 10-year yield, the 10-year yield is suggesting just that. Now, let's talk about the market. We spoke about the fear gauge, right? The volatility index last week and what that might suggest to us. Here's the volatility index. We talked about how every time we get a spike in fear, it coincides with a market sell-off, and we tend to get reversion back to the mean. If you look across the chart here, right, this is our volatility index. It is the same repeating pattern over and over. We get a spike in fear. If I brought up the market, it would coincide with a market sell-off, and then you get reversion back to the mean. So anytime we see the volatility index above 25 and really above 30, we start to feel that a bottom is near because, again, unless we have a systemic financial crisis, right, like the pandemic crash in 2020, the financial crisis in 2008, you generally do not see persistent readings on the VIX above 30 stay there for very long. So as the markets have recovered a little bit, we've seen the VIX come back down. Obviously today, the VIX is down another 10%. So we had a high last week north of 35, And here we are in just a couple short days, and the VIX has come down precipitously. So now let's talk about the market and let's set some expectations for what we think is going to happen in this market. Here's the S&P 500. Here's the correction we just went through and the subsequent relief rally. I want to point your attention to next week. Next week on Wednesday, Jerome Powell and the Federal Reserve will conclude their two-day policy meeting, and Powell will speak. And if you know how I feel about Jerome Powell behind a microphone, it's not something that the markets feel easy about. It's not always what he says. It's just the tone that he strikes and the fact that he tends to go off script. You know, we're kind of yearning for the days of Janet Yellen to come back because she never went off program and the market seems to like it. But nonetheless, Powell is our Fed chair. We're going to take what we have in front of us and we're going to make the most of it. So what we are expecting is a couple things. Is number one, right, we had a nice rally in the market, right, for the last couple months. Then we had the correction that we just went through. You can call this the Omicron correction. You can call this Powell's admission that inflation is not transitory correction. The market will always find a reason, folks. It does not matter specifically what it is, right? Nobody even remembers what the reason was for this correction back here, and this one here, and this one here, and so on and so on. But over time, the markets, like we said, go through three different emotional phases. The first is panic, the second is acceptance, and the third is indifference when we get over it and we make a move to new all-time highs. So here's what we expect from the market. It's not a guarantee, but from watching markets and identifying repeating patterns, here's what we expect. We'll likely see a little bit of a back test. What'll happen in a little bit today and into next week, right? Because people don't really want to front run the Fed, right? If you had new money to put to work, you're a brand new investor and you were aware of the Fed meeting coming up next week, you might say, you know what? Let me just wait. Let me see what he says. Let me see if Powell sticks to his word. The reason the markets are a little bit nervous about Powell is because under his tenure, we have had four policy about faces, meaning he has enacted policies and had to do a 180 and change 4 separate times. A lot of times because the market has pushed him to do that. If you think back more recently, December of 2018, Powell was raising rates when the economy did not warrant that, and the market threw a fit until he did an about face, right? So we're going to have a Fed meeting next week. We'll likely see a little bit of a back test, right? And this is normal after a relief bounce that's been as sharp as we've seen, right? You get 3 big up days. Now we're getting a little consolidation here. We'll likely see a little back testing. When this back testing comes, all the top callers and all the bears, right, the people pessimistic on the market, we call them bears, they're all going to come out of the woodwork. They're all going to take their victory laps. They're all going to talk about how this is a double top, right? And a double top means the world is over, right? We're going back down to the March 2020 lows. That is not what we see, but that is what you will likely hear. Because remember, in the media, panic sells, not optimism, okay? So we're going to get a little bit of a back test. We think this back test will be a great buying opportunity, and we think that this market is going to make a very powerful move to all-time highs, which will take us through the end of the year into the first quarter of next year and extending into the second quarter. Now, we just kind of drew it on you here on a couple lines here on the chart to give you an idea. As you know, in markets, nothing's a straight line, so we'll probably have some chop and some squiggly lines going here, but we think this will be the general pattern we will see. The suggestion we're making here also coincides with the fact that seasonality shifts dramatically on December 17th. December 17th on tends to be an exceptionally bullish time in the market for many reasons, one of which is a lot of capital flows come into the market at the end of the year, big, large pensions rebalance, retirement contributions come in, and we get outside of a period where people are doing tax loss selling. Let's take a look at the NASDAQ, right? We know our portfolio tends to track more closely to the NASDAQ as opposed to the Dow Jones and the S&P 500. So let's look at the NASDAQ. Similar chart, right? I have an additional line drawn here because I want to paint a picture for you. We have a psychological level that has emerged here, okay, for the NASDAQ. And as you can see, markets tend to probe around these psychological levels. And it's okay. Sometimes we see a little puncture through and then a back test, right? And a lot of people at this point felt, well, the game was over, right? We broke to new highs, we broke down, and here we go, right? And then boom, right back to it, right? Almost like a magnet, folks. Again, same thing. We expect to see possibly a little weakness, possibly a little back test before the market makes a powerful move to all-time highs. Now, you might ask, well, how can you make that type of suggestion, right? What evidence is there in the market that would suggest that this is the case? And let me introduce you to a couple of my friends. Number one, Apple, the largest stock in the market, approaching a $3 trillion market cap. Apple has blown right through previous highs and is ripping right now at all-time high levels. Microsoft, about to do the same thing. Now, there's many others I could show you, but why these two? These two are two of the largest components in the entire stock market. They are in all three indexes, the Dow, the Nasdaq, and the S&P, and they are also in many, many ETFs, exchange traded funds, mutual funds, and the likes, right? Growth funds, tech funds, Company America funds. They are in so many ETFs. Now, in our experience, when some of the market leaders, some of the largest market components are breaking out to new all-time highs, that is not a suggestion that the Nasdaq is going to roll over and play dead when these two are exceptionally large components in the Nasdaq. Okay, now, another thing I wanted to mention, I did not mention the other day. The correction we've seen in the broader indexes has not been that has not been that deep, right? Call it 5 to 8% given the index you're looking at. However, the average stock in the Nasdaq has corrected by 32% or more, right? It might sound like a bad thing, but what this would suggest is that the market has already undergone a major correction under the hood. This is not the type of activity you see in bubbles. This is not the type of activity you see at market tops. If everything was screaming up into the right side of the charts, that's when we would start to suggest things were getting a little bit overbought. In the Nasdaq alone, there are 37% of all the stocks in the Nasdaq that are down more than 50% from their highs. So what we believe that suggests is many stocks which have gone through a correction from the earlier part of the year, their February and March 2021 highs, are starting to get ready to bottom and make the next move higher. And a good example of that would be this software ETF. Now, we don't own this software ETF specifically, but a lot of the companies we own are components of this software ETF. And what do you see, right? We made highs in February 2021. We have a lot of consolidation, a ranging pattern here, lulling everybody to sleep in the market. We've made a couple attempts to break out. We haven't been able to do it, but this is all on declining volume, right? And ultimately, when we look at that, what it suggests is, we would like to see this low hold, which was the low from the end of last week. And, backfilling would be okay. A retest of the bottom would be okay. But this suggests that there's actually an opportunity for even more strength in this market, because while some of the mighty are pushing all-time highs and some of the indexes have held up very well, many of the individual components have already corrected, and we believe the direction from here will be higher. Again, probably not in a straight line, right? As pretty as these lines look, we know it's not always a straight line, but this is something that we see as evidence in the market that this market is far from done at this point. So let's check in on sentiment, right? Here's our fear and greed index. We're still in fear categories. This is a bullish setup for the market. When this market will be over, when this bull market will be over, will be when we have a correction like we just had, and we're still sitting up here in extreme greed categories, which would suggest that that recent correction didn't shake investors at all, that people have an unshaken belief that markets will go higher. Markets are very contrarian in nature. This is evidence of that, and we are seeing people are still absolutely terrified of this market. That is good. That means they have one foot out the door. They're being shaken out of this market, and once they get out and the market starts to run, they will chase this thing back up like a herd of cattle, and it will be lighter fluid on the rally as it's underway. So we wanted to share our perspective with you on this. We got some good feedback last week when we talked about and shared, some of the visuals, and it's very important that we think that you understand there's always a plan. We always have levels that we're watching on the upside as far as price targets, and on the downside as far as price invalidation levels. We will respect those levels. We are not emotional in our approach to these markets, and we believe that there's a lot of nervousness around this market. Omicron, interest rates, inflation, Fed policy change, and that's understandable, but the market always climbs a wall of worry. There's always problems for the market to overcome, and ultimately there will always be problems for the market to overcome. But it's important to keep in mind a couple key factors. Is number one, the Fed is not tightening monetary policy. They are just taking their foot off the gas pedal. We're not touching the brakes right now. We are just easing off the gas pedal. Markets are going through an adjustment period like they always do when we have changes in Fed policy. But we believe the evidence is here that the market is going to shake out a little bit longer, probably a little back test. We don't think that we will invalidate the lows here, and ultimately this market will move on to new highs. And when it does, many of the stocks that we own will outperform on the way up. So we understand that a lot of the components in our portfolio, some look great, some have not looked so good because they're correcting right now. Some are down much more than the little 5 to 7% correction we've seen in the market. That is the price we pay for growth. And ultimately, nothing has changed but price in some of those companies. And when nothing changes but price, meaning the underlying fundamentals of those companies are still intact and still look good, we call that a buying opportunity. So I want you to remember, markets bottoming is a process. It is not a single day event. Just because we had a bounce here and a little backfill here doesn't mean, oh boy, the market is going to roll over and play dead yet again. So again, expect a little weakness into next week, the Fed meeting. That doesn't mean it's going to happen. Maybe we come out Monday and the market takes off like a rocket and never looks back. That is possible too. Again, like I said earlier, this market is suggesting through the 10-year, through the bond market, that it does not believe that we have a Fed that is getting hawkish and going to tighten policy. And little known fact, the bond market is about 3 times the size of the stock market, right? So we all know how many trillions of dollars are in the stock market. The bond market is way bigger, and the bond market has always had a keen sense to try to sniff out these moves and identify and suggest where things are going to go before they happen. So if you have any questions, please reach out to us. We're always here to talk to you about anything that matters with your money. We're very confident in our outlook for this market. We think we just have to go through a little more volatility, a little more turbulence, but we think there are clear skies ahead. I hope you guys have a great weekend, and we will see you back on Monday for the Heritage Market Minute.